Drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
Hello students, welcome to atptable.com, your online gateway to the world of invaluable knowledge. Our last discussion was focused primarily towards the present value of growing annuity concept, and we tried to understand that how exactly the discounting method plays a very important role in developing the conceptual framework for the present value of the growing annuities. We also try to understand that the present value of growing annuities follow a geometric progression, and the most ideal case for developing the formula for the present value of growing annuities rests upon the assumption that R is less than 1. Secondly, we also discussed that the formula derivation depends heavily upon the interaction of two variables, that are the I as well as the G. I stands for the discounting rate of the required rate of return, while G stands for the percentage growth with which the annuities are growing. We discussed that it is the interaction between I and the G under the light of three conditions which lay the foundation for the development of the formula, or for the construction of the formula for the present value of growing annuities. The three conditions which are a result of the interaction between I and G are: the first condition is a condition where I is more than G, that is, the discount rate is more than the growth rate, and the second was the condition where I was less than G, the discount rate is less than the growth rate, and the last is a condition where I is equal to G, which means that the discount rate as well as the growth rate are just the same. We also discussed yesterday that for the first condition, that is wherein the I is more than G, it could be understood from the point of view of two different entities, that is, first from the point of view of an individual and second from the point of view of a company. Yesterday we discussed in a very brief fashion that why for a case of an corporate entity the growth rate should be lesser than the discounting rate, or rather why the discounting rate is actually higher than the growth rate. We discussed an important point that in the short run it is possible for the growth rate to exceed the discounting rate, but the sustainability of a higher growth rate as compared to the discounting rate in the long run is a remote condition, or it is just nearly impossible. We have seen that a discount rate is always being developed after taking into consideration the risk premium, and we have also seen that when the investors are investing a long-term capital, they are parting away from their wealth for a longer time frame, and going by the basic conceptual knowledge which we had during our earlier lectures, that as the time frame gets longer and longer, investors tend to put a higher risk premium up and above the risk rate of return, with the help of which they calculate the RS, which is the cornerstone of the CAPM model. So students, this is the main reason why in the longer run the growth rates are not usually higher than the discounting rate. We also saw that in the longer run there is a lot of competitive pressures, macroeconomic conditions, international conditions, a drastic change in the business environment takes place, with the help of which it becomes very difficult for a company, no matter how profitable they are, no matter how technologically sound they are, no matter how much the best of the resources they are employing, it becomes quite difficult for them to maintain a high and a steady growth rate which is even higher than the discount rate. Much on this when we discuss our successive lessons. In our today's discussion, we will try to understand the concept of a higher discount rate as compared to a growth rate from the point of view of an individual investor. If we try to look at the entire phenomenon from the eyes of an individual investor, in a very simple manner, we can establish a point that when annuities are growing by a certain percentage, which is being represented by the growth rate, and if that growth rate is lesser than the reinvestment rate or the discount rate, obviously it throws up a very lucrative proposition for the investor as well, who is an individual mainly. As you may go through this, and you may find that it is written over here that this is the most common condition wherein the rate of return is greater than the growth rate of the annuities. Investors prefer this scenario where they can earn a higher return from the already growing annuities. Example, Mr. X receives an annual growing annuity at the rate of 10% per annum and deposits it every year in a bank, giving him an I of 12%. It is a very simple condition, students, that which says that if investors are getting a growth rate of a fixed percentage from their annuities, and if after getting a stream of annuity which has grown by a certain percentage, if they are in a position to reinvest those proceeds into another investment option which is giving them a higher rate of return, if they are reinvesting the proceeds into another investment option from which they can earn even a higher return, then this is something which lures the investors more towards such an annuity. Because obviously when investors are receiving an annually growing annuity amount, and if they are in a position to reinvest it and again earn a higher return by way of a higher reinvestment, this is a kind of a double benefit or twin benefit for investors. So naturally they will not say a no to this particular proposition. Like, as you can see that if Mr. X receives an annual growing annuity at a rate of 10% per annum and deposits it every year in a bank, giving him an I of 12%. Obviously it goes without saying that the annuity which is being received by Mr. X, it is growing by 10% per annum, and when at the end of the year he is reinvesting it by depositing it into a bank, that particular annuity is growing again by the rate of 12%, because the bank is giving him a yield of 12% on the amount which has been deposited. Rather, the annuity and amount which has grown by 10%, when the same amount is been again reinvested into a bank which is giving him a return of 12%, it is a very profitable proposition for Mr. X. So in this particular case, investors will try to get into such annuity payments commitment wherein the annuities which are growing by a certain percentage grows further when they are reinvested into another reinvestment avenue wherefrom they are getting a higher return on the already grown annuities. I hope this particular point is clear, students, because this is the point which leads to a conclusion that even in the case of individuals, the I or the reinvestment rate or the cost of capital that is higher than the growth rate, and we shall be seeing shortly that if I or the discounting rate is more than the growth rate, then invariably the R is going to be less than 1. Why? Because we have already discussed that even in the case of growing annuities, the R or the common ratio is equal to 1 plus G upon 1 plus I. It is not the other way around. It is always 1 plus G upon 1 plus I within the small brackets is equal to R. So R is the common ratio by which the annuities of A upon 1 plus I, that is the first term, that is the A, that is the first term, is equal to A upon 1 plus I. It is growing by an R or a common ratio of 1 plus G upon 1 plus I. So if the growth rate is lesser than the discounting rate, so the numerator being lesser than the denominator, the resultant has to be, or the resultant R has to be less than 1. As I've already discussed, and we shall be seeing shortly, that R being less than 1 is the basic condition which is required in order to derive the final formula for the present value of the future annuities. Now students, coming to the second point or the second condition, you shall see that the second condition is a condition wherein I is less than G. So if I is less than G, then invariably our R is going to be more than 1. If I is less than G, our R is going to be more than 1. But is this condition a very lucrative one? Even from the point of view of investors, I don't think that it is a very lucrative proposition wherein the I is less than G. It means that the annuities are giving a higher return to the investors rather than the reinvestment options, which were giving a higher return as in the first case. It means that the investors won't be getting any reinvestment benefit, because upon reinvestment the rate of interest which they shall be earning, that is a I, that shall be lesser than the growth rate of the annuities. So it is written that this is the most impractical situation, as no rational investor shall like to opt for a case wherein his annuity growth rate is more than his required rate of return, that is I. Because in such a case he would have been better off in enjoying an increased amount of annuity growth rather than reinvesting it against a lower yield than I. For example, Mr. X will opt to enjoy his annuity return of 10% only rather than reinvesting it into a bank deposit yielding him an I of 8%. Obviously, it goes without saying that if Mr. X is getting a return of 10% as a growth in his annuity, and if upon reinvesting he is getting a return of 8% only, he shall be happier, or rather he shall be happier in sticking to his annuity growth of 10% per annum. Even from the company's point of view, also students, this condition is possible, but in a very remote condition which cannot be sustained in the long run. So in a shorter run this condition can prevail, but since we know that the companies are working on a going concern basis, they are always they undertake operations, they purchase long-term assets with a long-term time frame in their mind, so they are more concerned with the long-term return on the investment rather than opting for a high and a very astronomical return on investment at the short run, but being unable to sustain it in the longer run. So that's why this situation is a bit of a impractical one, as well as it is a very short-lived and a short-term based situation. Now the third option is a condition wherein the I is equal to G. That means it is a condition wherein the growth rate of an annuity is exactly equal to the required rate of return or the discounting rate. It goes without saying that if the numerator and denominator both are having the same number, then the resultant R is bound to be 1. So the R will be 1 in the case of I is equal to G. So although this is not a remote possibility, but this condition can happen quite seldom, that wherein the growth rate of annuity is exactly equal to the reinvestment rate from the point of view of an investors. Even in the case of companies also, at a period of a constant growth, this particular condition might happen, but again the possibility of happening this condition is not as profound, it is not as high as that of the first condition wherein the I is more than the growth rate, or the discounting rate is more than the growth rate. Moreover, how exactly the condition pan out over here we shall be seeing in the next slide, while we shall be talking about the formulation of the formula. Now let's come back to our first condition wherein the I was more than G. As a result, the resultant R being less than 1. The formula for present value of growing annuities changes under all the three conditions. As I've already told you at the very onset itself, students, that the final formula for calculating the present value of a growing annuity shall be determined based upon the interaction between I and G. It is the interaction between I and G which shall decide that how exactly the final formula takes shape. So till now we have discussed briefly regarding the interaction from the point of view of three conditions, wherein the I was more than G, I was less than G, and I was equal to G. Now let's try to restructure the entire discussion, the conceptual discussion from the point of the formula. So as mentioned above, the formula undergoes a change in each of the three individual conditions, of course. So as and when the conditions are changing, till now you might have noticed, students, that under all the three conditions wherein the I was interacting with G, the resultant R was changing as per the change in the conditions. Like I said, that in the first condition wherein your I was, or the discount rate was higher than G, it was a condition where the resultant R, or the common ratio, was less than 1. In the second case where the G was more than I, the R was more than 1. In the last case where the G was equal to I, the R was equal to 1. So you might remember that all these three conditions wherein the R is more than 1, R is equal to 1, and R is less than 1, they are the same conditions, they are identical conditions which we learned at the very beginning itself when we were talking about the derivation for the formula of annuities in order to calculate their valuation, we were taking the help of the geometric sequence, and in order to calculate the sum total of the sequence of which is geometrical in nature, the interaction of r with 1, whether it is r is more than 1, r is less than 1, r is equal to 1, it was very, very important. It was that interaction between r and 1 which helped us in developing the three formulas, wherein in the first case where r was less than 1, then Sn was equal to a into 1 minus r to the power n upon 1 minus r. In the second case where r was more than 1, the formula was Sn is equal to a into rn minus 1 upon r minus 1. In the third case where r was equal to 1, it was n into a. So again, bringing that particular concept into the action in this particular case, also we can see that why is it told over here that as mentioned above, the formula undergoes a change in each of the three individual conditions. It is so because under each condition the r or the common ratio is changing, as you can see it by now, that under all the three conditions during the interaction between I and G, the resultant r or the common ratio is undergoing a change. Like in the first case where I was more than G, R was less than 1, where G is more than I, R was more than 1, and where G is equal to I, R was equal to 1. So once again, the same concept which we discussed a few illustrations back or a few discussions back, that is again coming back to the fore and helping us in understanding the forthcoming conditions also. Now condition 1, where the first condition where I was more than G, the R shall be less than 1 or R is less than 1. It is the same thing which we discussed, that when I or discount rate is more than the growth rate, the denominator is higher than the numerator, therefore the R is going to be less than 1. And when R is less than 1, the main reason I've just discussed, because 1 plus G is less than 1 plus I, therefore R is less than 1. Now for example, the growth rate is 10% or the I is 12%, therefore R is 1.10 upon 1.12. It is bound to be less than 1, that is 0.98. As already discussed earlier, the condition 1, wherein the R is less than 1 because the I is more than G, is the most logical and rational approach which is adopted by the investors as well as the companies also. But since right now we are concerned more with the individual investors, so we are restricting ourselves to the investors only. Now since R shall be less than 1 under the first condition, the formula Sn is equal to A into 1 minus Rn upon 1 minus R as the sum of a geometric progression where R is less than 1 shall be adopted to construct the formula for the sum of present value of growing annuities which progresses as per the geometric sequence. This entire discussion is self-explanatory, student, because because explanation of the same I have given you a couple of minutes back, but again just for your recall, for a better understanding, I shall be explaining myself once again. This is something which you all know, we just need to refresh our understanding. When we found that R is less than 1, because R is bound to be less than 1 because I is more than the growth rate. So when R is less than 1, so obviously we shall be applying the formula of Sn is equal to A into within small bracket 1 minus R to the power n upon 1 minus R. I'm sure you all are well acquainted with this particular formula. This is the formula for the sum total of the geometric progression wherein the R is less than 1. So obviously when this particular formula is applied for such a geometric progression where R is less than 1, this case is absolutely identical in this particular condition also, wherein the present value of the growing annuities is also having a common factor R which is less than 1. So when in the present case also, in the case of the growing annuities also, in the condition of having the urgency of deriving the present value of the future sum of the present of the growing annuities as a condition where R is less than 1, we shall be applying, taking help of the same formula, because the sum total, I repeat student, the sum total of the present value of the future annuities which are growing at the rate which is lesser than the discount rate also follows a geometric sequence, because this is something which we already saw yesterday when we were trying to understand the basic derivation of the formula. We saw that the present value of the growing annuities are also following the geometric sequence with the first term a being capital A or the annuity upon 1 plus I, and the R was 1 plus G upon 1 plus I. So in order to develop the final formula of the present value of growing annuities, we shall be taking help of the mother formula, wherein Sn is equal to A into within bracket 1 minus Rn upon 1 minus I upon 1 minus R, under the condition of R or the common ratio being less than 1. So how it happens, we shall be now seeing it. I hope till now the discussion is clear, students. In our successive discussion, we shall be trying to apply a derivation of the formula. That's all for now, students. Thank you, students. Happy learning.